The following is a presentation of TFNN. The Morning Market Kickoff with your host, Tommy O'Brien. Now, Tommy O'Brien.
Good Friday morning, everybody. We come back from another holiday yesterday, Jimmy Carter Memorial, and boy, we got a jobs number this morning. 256,000 jobs added in the month of December. The Fed has no reason to cut when this economy continues to power forward well above expectations. But guess what, folks? Markets are trading off of rate expectations yet again. And what that means is that good news is bad news. And you're getting the reaction today because the market was thinking maybe we'll get some news that we'll get some rate cuts coming down the line. That is not happening. We got the 10-year spiking. You have the 10-year right now with a yield of 4.77%. We'll jump over to that in a moment. We got markets in negative territory on the jobs number. And we get the S&Ps negative by 0.8% or 48 points in the red at 59.11. NASDAQ 100 off by about 1 percentage point. You see the spike there down to 21,045. We're 100 points off that low, but still off by almost a full percentage point, off 204 points in the NASDAQ 100, 21,155. The Dow off 0.7% or 288 points, 42,590. And watch out for the Russell, off 1.75% or 39 points in the red. And the Russell in particular, they have a lot of rate exposure. Okay, they have a lot more short-term debt. They're a lot more prone to the overnight lending rate versus some of the large cap tech companies that have longer term duration. They're not as impacted by shorter term rates, but when the Fed is not going to cut, and they're not going to cut right now, man, how about 50 basis point cut in September? That is a long time ago, man. You think about where we are right now. This economy just keeps going. We got unemployment at 4.1%. We have jobs, 256,000 jobs added, unemployment at 4.1. We have yield spiking. We jump over to the dollar. How about that? Yeah, you're talking about being within almost 4/100ths of 110 on the dollar, and you put this thing on a daily. That is a breakaway, man. That is a breakaway to 110. You see the chop. The only thing hanging out there is this high of about 114, and that's going back to October of 2022. Pretty remarkable when you back things up to how quickly things have changed since September. And we got to update that one. Let's delete that one because we're talking about 4.77. 4.77, up by about 8 basis points. The yield on the 10-year, you see the breakaway to lower price. We're trading at a 107.18 price point. Yeah, just off of where we were. And look at that move, man. The 10-year has traded down more than 8 full points from 115.23. This is where they talk about fixed income. You run and you hide in fixed income. Not many people realize the losses that are possible on an upfront basis when you get moves like this, especially when you go out to duration. That's your 10-year. You jump over to the 30-year. Yeah, look at the 30-year, man. You just traded from 127 to 111 over the period of September. Now, remember, in September, this market was pricing in 5 Federal Reserve rate cuts in this calendar year. We're now in 2025. Let me say that again. In September, and this isn't counting the cuts that we already got. The market was pricing those in, but then they were also looking forward to 2025 and pricing in 5 cuts. Market's pricing in maybe 1 cut in October now next year. We'll pull that up. Quite a change. What I will say is this is a much more reasonable stance per the economy. When we were talking about in September, folks, hindsight 2020, but we kept talking about it, saying, man, the market's pricing in like 6 cuts right now over X meetings. Nonetheless, here we are. We're repriced. We got the 10-year at 4.77% right now. And let's take a look at the yield curve as we jump around. You're talking about higher yield up and down. How about the 30-year? 4.98, pushing 5%. The 20-year is above 5% right now. There's your 10-year at 4.76, up 8 basis points. You jump over to the 2-year, right? The 2-year and the 3-year, the shorter term impacted by the Fed. I guess you go out to the 7-year as well. But yeah, the 2-year up almost 10 basis points to 4.35%. Yields rising as this economy just powers forward. So we have the unemployment rate of 4.1%, 256,000 jobs added for the month of December. I want to get into some of the numbers here. I was scrolling through. Oh, it goes so quickly. All right, I'll catch up with it when we go to the first break. There were a couple here I want to go over. Yeah, check out this one, right? Everybody is doing well right now. White jobless rate down to 3.6 from 3.8. Black jobless rate down to 6.1 from 6.4. Asian 3.5 from 3.8, and Hispanic 5.1. Relentlessly strong economy. That's the point. Relentlessly strong economy right now. When you have unemployment at 4.1%, you're adding 256,000 jobs added in the month of December. And we have a Fed that's talking about cuts. Think about that in your mind. If we didn't have recency bias, okay, let's jump over to the dollar again, see where it's spiking, 109.66. We take a look at the gold contract right now. Gold catching a bid. We got stronger yields, and we have a stronger dollar, and we have equities taking it on the chin, but we have gold acting as a safe haven, up more than 1%, up $27. Now, here's the kicker in my opinion, okay? You're not going to get a next escalation to higher prices until you get a dollar pullback. But what gold has done is it's managed to consolidate around 26 to 2,700 while you've had the dollar over that period of time go from about 100 to 110, okay? You know, our man Steve Rhodes, he loves looking at gold and other currencies. It's a great way to look at it because gold is almost a currency. It's a commodity, okay, but it's priced in it. Any other currency, man, you're just seeing gangbuster accelerations. But the fact that gold has been able to consolidate in U.S. dollars when you've had the dollar go from 100 to 110, I think this is the next setup, as in you consolidate, we get through this dollar strength, and I don't see gold pulling back harshly when we get any dollar weakness. I don't see it happening. As in, it traded in tandem on the way up, right? Today, we're getting dollar strength. We're getting gold acceleration. But if we see a dollar pullback, that will be the wind at your back in that gold contract. And we'll see if it plays out. But gold, remarkably strong for a safe haven. You're above where we were on September 26th, which was when the dollar was trading at about 100. Remarkable, right? You look at this chart, okay? There it is, right? The dollar's been a straight trade higher, while gold has held on well. If you told me in September, when the dollar's at 100, when gold was trading at about 2,700, and you said, hey, you know, some things are really about to change for the Fed forecast here. We think there's many cuts. We think that we're going to get a lot of cuts. But guess what? That's going to change. We're going to see yields spike. We're going to see the dollar strengthen from 100 to 110. Where do you think gold's going to be? If you told me gold's going to be sitting above 2,700 right now, when we're pushing 110, would have been hard-pressed to believe that idea, but that is how strong gold is held up in this market. All right, we got a lot to talk about, folks. Friday in the market, another shortened holiday week, and it is remarkable here. We get this is the third consecutive week. We've had 4. We got to go to break, folks. We'll be right back. We'll finish it up. Stay tuned. If you're looking for potential trading setups in the stock market, then Rocket Equities and Options Report is a newsletter you should try. Tommy O'Brien delivers options and equity trades when the markets present them, using a combination of fundamentals and technicals. Sign up for Rocket Equities and Options Report today with a 30-day money-back guarantee, so you have nothing to risk. For all the details and to start your subscription today, visit the front page of TFNN.com. TFNN, educating investors.
In the world of trading, only a few names stand out like Larry Pesavento, a pro's pro with over 50 years of experience. Larry has seen it all. A former Chicago Mercantile Exchange member, Larry has authored 10 books and trained over 1,000 traders with his unmatched expertise. Introducing Fibonacci 24/7, Larry Pesavento's daily trading service that turns the complexity of markets into opportunities. Published every Sunday, receive a comprehensive report packed with detailed commentary, charts, and videos that illuminate the patterns shaping the markets, with updates throughout the week exclusively for subscribers. Whether through charts or videos, Larry's analysis is your roadmap to navigating the markets. You can sign up now at TFNN.com for just $97. And with all TFNN newsletters backed by a 30-day money-back guarantee, you have nothing to risk. For all the details, visit TFNN.com. You'll find Fibonacci 24/7 right under the newsletters tab.
Building wealth trading in the stock market seems impossible to most people. They think it's too volatile and risky. Most people aren't going to take the time to educate themselves on how to do it right. But you're not most people, are you? At TFNN, you'll get the guidance you need to refine your strategies and techniques to invest like a pro. Because you'll be a pro. All TFNN subscriptions, books, software, and courses are available at TFNN.com. And I'm even going to tell you how to get them for less. Use TFNN's Tiger Dollars and you'll get up to a 20% bonus on your purchase. And once you apply them to your account, Tiger Dollars are automatically used for all future or recurring charges. Tiger Dollars also never expire, are fully transferable, and are a great way to add savings to your newsletters or services. Become the investor you were born to be at TFNN.com. TFNN, educating investors.
TFNN has launched the Tiger's Den, hosted at Discord. TFNN has been educating traders for more than 20 years with live programming hosted by a variety of professional traders during market hours. The Tiger's Den, available to all tigers and tigresses for just $1 for the year. There's no catch or added costs when you join our community of traders. Sign up today and become a part of this educational community of traders. Just visit the front page of TFNN.com.
This portion of the Morning Market Kickoff is brought to you by Direxion's daily leveraged and inverse ETFs. Whether you're a bull or a bear, you choose the direction. Visit Direxion.com. Investing in the funds involves significant risk and should only be utilized by investors who understand the impact of leverage and actively monitor their portfolio. They are not designed to track the underlying index or security for more than a day. Before investing, carefully consider a fund's investment objective, risk, charges, and expenses contained in the prospectus available at Direxion.com. Read carefully. Distributor Foreside Fund Services, LLC. Welcome back, folks. We got markets in negative territory following a strong jobs number, and we are back to good news being bad news and bad news being good news as rates in focus right now. The number coming in at 256,000. You check it out on the chart. That follows a very strong November number as well. Remember, October, a little bit of an anomaly there. What was that number? It was tiny, right? What was it like? Was it 26,000, 6,000, something tiny? Nonetheless, the expectation was for 155,000. You come in at 256. Okay, very little revisions on the prior numbers, so nothing to distract from the fact that you're 100,000 plus over where you are on the expectation side. Unemployment 4.1% coming down on a wage basis, 0.3% gain in wages. That was right in line with expectations. If you were dropped into this scenario, right? Imagine. Let's say you're taking economics in college and they ask you for a scenario analysis and they give you the fact that markets are trading with equities at 6,000, basically near all-time highs. You're talking about equities at 6,000 when you came into COVID at 3,300. You peaked out at the end of 2021 at 4,800. We've surged from 3,500 just over 2 years ago to 6,000. This is the question I'm presenting you, okay? We have unemployment that's sitting at 4.1%. There's your unemployment rate chart. We're down from the COVID acceleration, okay? We're up a bit from when inflation was soaring, but we now have settled for much of 2024 at 4.1% is the number there, okay? And then there's the non-farm payroll numbers added, okay? For 2024, you're talking about the U.S. added last year 2.2 million jobs for the year, more than double the number that was expected by economists heading into the year. Listen, politics get into it, man, okay? But if Trump was running that economy, that's all you'd hear, okay? Now, COVID, down 9.2 million shares. We lose 9.2 million jobs in 2020. You get back 7.25, 4.5, 3 million, and then we still are at 2.2. The point being, look at where we were coming in. We're on like pace again. We're on pace with unemployment at 4.1%. That's the remarkable part. We've added this many jobs with unemployment kicking off the year with a 3 handle. Very difficult, okay, to do that. Now, there's the question. There's the situation they lay out. The question is, does the Fed need to cut to spur the economy, to risk full employment at this price level? Think about it. The Federal Reserve have 2 mandates. Full employment, we're sitting at 4.1% right now, and price stability. Price stability has come back down to a more reasonable level. Not quite sure it's at their goal of 2%. Not sure they're going to get to the 2% number. But nonetheless, I think you'd be hard-pressed to make the case that they need to come in cutting with any type of a force. There's a recency bias going on in this market, okay? When you back things up to where we were for 0% interest for so long, and look at what equities have done during that time, okay? You back up the 30-year, because that goes the furthest on the chart, and yeah, since 2008, when we discovered 0% interest rates come out of the financial crisis, we saw yields continue to drop, approaching the 0% bound, right? And boy, have we recoiled. Now, you look at this chart of the 30-year, and you say to yourself, well, geez, we're at some of the higher levels with the 30-year pushing 5% that we've seen in some time. It's probably a good trade here that you could buy this, you could expect yields, but guess what? That's only basing things off 2008 till now. I know it's 17 years, okay, but that is recency bias in a market that we've had rates so low for so long. If you said the same thing at 2008 and then going to the left anytime prior, you could actually look at that chart and saying, hey, you're kind of buying this at cheap yields right now. You're buying it at high price. We've seen a lot of lower prices over the years. Folks, the economy was doing well. 1996, 1999, okay, wherever you were still. Point being, we could be higher for longer right now. And if that's the case, this is what equities have done since we've been in 0%, okay, from 665 to 6,000. When we had interest rates with a more reasonable yield, that's what the market can look like occasionally, okay? That's your S&P. Those aren't growth stocks. Yeah, that's an S&P where for a 12-year period you broke even from 96 to that same low you got of 665 in 2009. So there could be some volatility coming down the line here. There is no reason for the Fed to need to cut in this environment right now. Cuts are pushed back. And yeah, there's no reason why they can't if we're adding over 250,000 jobs on that degree. Now, what I will say is, you look at this chart, on non-farm payrolls, we have a lot of variance going on, right? You have huge months, you got pullbacks. We had storm volatility in there. We had the 2 storms in Florida. You had storms throughout the country. You had snowstorms. Maybe that's a bit of a recoil. Maybe some of the hiring in there wasn't supposed to, didn't happen. Back on the October small number, couldn't catch up quite in November. You've added in December. Maybe there's some lag. Maybe that trails off. Okay, these are the lags that are possible on that type of a number, but man, overall, seems like the Fed's got a lot of room to wait here. As in, what's the risk? The risk to the economy, to full employment? We got 4.1% unemployment right now. And I think that's where we go from there. We got S&P's off 43 points, NASDAQ 100 off 199 and 192. And let's check out some of the magnificent equities right now. You got Amazon shares. They're going to open down more than $1 to about $2.21. We were all the way to $2.19 in the pre-market. You jump over to Apple shares this morning, down to $240.18 right now. Nvidia closed at $140. You're looking at an open near about $137. Microsoft at about $420. Jump over to Tesla shares. Trading down about $3 to $3.91 for Tesla. We check out some of the other chip stocks. Intel slightly in the red at $19.66. Broadcom shares trading at $2.25. Let's back this one up. Yeah, Broadcom holding up pretty well. Yeah, quite the acceleration, man, from 178 to 250, and I'd say we're holding those well. All right, the dollar's giving it back a bit. We just traded down 500 points from 109. We're almost sitting at 110. We're at 109.5 right now in the dollar, and we check back in on yields coming into an important opening bell, and yields recoiling just a bit right now. The slightest it could, as we're dealing with a 10-year yield of 4.75%. We're coming back for the opening bell. We'll take a look at some other equities. Don't go away, folks.
This market has turned red, Tigers, and the question we should be asking ourselves is how to position for a potential bear market. Plenty of gains can be made in bull markets, but if we've entered bearish territory, that strategy needs to change. So, how do we pivot so we can see green in the red? Join Larry this month, January 10th and 24th for live trading action. You'll sit next to Larry as he places live trades, explains his methodology, and answers questions live. Larry brings his decades of trading knowledge directly to you, teaching you how to navigate this shifting market. Go to the front page of TFNN.com today and secure your spot fast for live trading Fridays with Larry Pesavento. Happy New Year, Tigers. We'll see you January 10th and 24th. TFNN. Educating investors.
If you spend any time online researching trading techniques on how to begin your trading journey, you've no doubt come across many folks who push Forex trading as a way to make big money quickly. Unfortunately, there are equally as many stories of these so-called Forex professionals just looking to make a quick buck off aspiring traders without actually teaching the ins and outs of the Forex market. This is what sets Teddy Keckstack's The Tiger Forex Report off the riffraff. Every Monday, former Chicago Mercantile Exchange member and author Teddy Keckstack releases his Tiger Forex Report newsletter, where he dives into the complex world of Forex and takes time to actually teach you his methods that have made him so successful in the fast-paced and rewarding world of Forex trading. Furthermore, all subscribers receive access to archived live streams of Teddy's, where he provides university-level education to help you in Forex trading. All first-time subscribers receive a 30-day money-back guarantee. So what are you waiting for? Forex awaits.
Steve Rhodes started his trading career as a student almost 20 years ago, and the student has now become the master. Steve won the prestigious Timer of the Year award in 2018 and barely missed that mark again in 2019, finishing at number 2 for the year. An amazing accomplishment. Steve Rhodes is committed to sharing his techniques and knowledge with anyone who wants to learn, and he shares his vast amount of trading knowledge every day in his Mastering Probability newsletter. Steve's award-winning newsletter, Mastering Probability, is delivered every trading day with updates throughout the afternoon. Sign up for Steve's market newsletter, Mastering Probability, and you'll receive access to 7 of Steve's educational webinars absolutely free. At TFNN, all our newsletters come with a 30-day money-back guarantee, so you have absolutely nothing to worry about. Visit TFNN.com and try Mastering Probability 30 days risk-free today. TFNN, educating investors.
Don't forget, you can listen to TFNN live on your mobile device 24 hours per day. Go to TFNN.com, then hit Watch Tiger TV. That's TFNN.com, then hit Watch Tiger TV.
Welcome back, folks. Markets are open. S&Ps kick things off, down about 0.7%, trading off 43 points at 59.15. You see the action, though. We've gotten back almost 30 points from that spike low of 58.88. NASDAQ 100 down 190 points, or 0.9% right now, 21,166. You got the Dow off about 0.5%, 42,644, and the Russell leading the way, off by 1.9%. We jump over to yields right now. There's your 10-year. And we're sitting at about 4.75%. Exactly, 4.75%, the yield on the 10-year. And dollar strength holding up well, 109.55 on the dollar. And yeah, you look at this thing on a daily, you look at it on a weekly, decisive break. The weekly is what I like most because that encapsulates the full move you had in 2022, and this is almost matching it. We were the only game in town back then, okay? And to a certain degree, we're the only game in town right now. American exceptionalism is as they talk about it, and boy, you know, we're all humans, we're all people, but the economies, they're not created equal, okay? And American exceptionalism, when it comes to our economy, we're on fire, man. 256,000 jobs added, unemployment at 4.1%, and you have inflation that the Fed still argues is on its way back to 2%. Then what are we doing? Let's just let things work their way through. There's no reason for cuts. If anything, you can make the case with unemployment at 4.1%, with wages up 0.3% on a month-over-month basis, in line with expectations. Folks, you multiply 0.3 times 12, that's a 3.6% raise on a yearly basis, right in line with a healthy economy. If anything, at 4.1%, I would be worried about inflation right now. We almost still have a 3 handle on unemployment in this economy, which is remarkable when where the Fed is. And yeah, we're seeing a tick lower yet again. And we'll see where we end the day. But it's Friday. It's an interesting one. And yeah, we will find out. All right, we jump around to other stories out there. You got Walgreens out with their numbers trading higher. Big earnings beat as they cut costs is the story there. Yeah, they maintain their 2025 outlook, okay, of $1.40 to $1.80, but you come in with 51 cents versus 37. Revenue, a big beat there as well, and they bring it down to the bottom line. And they're looking at revenue for the fiscal year, $150 billion, around that number, man. It is a big number. 8,500 locations. The retail pharmacy division generated $31 billion in sales in 90 days, up 6.6% from the same period last year. Analysts were only looking for $29.2 billion. Huge beat. I wonder how you can be that far off on something like pharmacy. Pharmacy sales for the quarter rose 10.4%, and comp pharmacy sales increased 12.7%. Comp pharmacy sales. Who are they eating up? Are they eating up Publix pharmacy? Who's losing their pharmacy battle? Now, it does happen with insurance, what it is, right? I have Blue Cross Blue Shield, and so as a result, I have to go to Walgreens. Can't go to CVS. So those types of deals always matter, but that is a remarkable number on a same-day basis, same store comp sales. Yeah, and even a bigger number, I thought. Look at that, catching a bid on the open. Impressed by those numbers. And Walgreens Boots up by 21%. Now, this stock's had some problems, but that could be a turnaround, man. Put it on your radar, okay? Because those are blowout numbers. They beat all the expectations, which means the analysts aren't paying attention to what's going on. They missed something, man, to miss that type of a number. You come in at 925, and we got an 11 handle with Walgreens. CVS, a little bit of a lift as well, up by 2.2% following the Walgreens numbers. Delta, yeah, they come out with their numbers as well, so up by 8.2%. They like the Delta numbers. Haven't dug into those, but check it out. You're back to pushing the highs of last year yet again. These airlines are on fire, man. United, up by 3.2%. They're liking with whatever Delta said. A little bit of a pullback. Let's see how JetBlue is doing, the dog of the industry right now. up by 1% in a negative market day. Amazon down about 0.8% right now. You got the NASDAQ 100 down about 1%. You got the S&P's off 50 points. That's about 0.9%. Dow off 0.7%, but the Russell really taking it on the chin, man. The Russell, as I mentioned, small cap stocks. When we come into this break, I'll try and find the article. Small cap stocks going to be heavily dependent on the Fed. And boy, you take a look at your pullback. You're talking about giving up 10% from where we were November 25th, just like that. We're off by almost 270 points, almost an 11% drop from where we were. You take a look at the weekly. Let's go back to the monthly. And yeah, look at this, man, right? The high was 2460 in 2021. We eclipsed it by 17 points. And then, boom, we've sold off. And rates don't seem like they're going to give it up anytime soon. Okay, we keep our eye on rates as the market is open. And just chopping around with the 10-year, sitting at about 4.75%. Now, one thing I did talk about with rates, I think it was Tuesday or Wednesday on the program, was that if volatility comes down, as in if the market starts to adjust for a higher for longer, you could actually see the spread tighten between the 10-year Treasury and the 30-year mortgage rate. Right now, that spread is approaching about 1.5%. Historically, it can be at a number at about 1%. So you could actually see mortgages stay where they are, even come down a bit, if that volatility in that market allowed for some of the players in that market to go out duration, right? Allowing them to give a bid for the longer-term duration, which 30-year is. So you give a bid, that brings down the yield on the 30-year, that tightens the spread between the 10-year Treasury and the 30-year yield. And I think that's what's going to happen eventually. So I don't anticipate that mortgage rates are going to skyrocket, even if the market adjusts to a 10-year approaching a 5% yield, because in theory, you could have the 10-year at 5%, and you could have mortgages come down to 6.25% to 6%, and that would be a healthy spread that's been there on the longer term. You'd need to have the volatility come down, though. You need to have it. You need to have the market get out of their head that somehow this Fed is going back to where we were for a long time. That's not happening. This market can handle a 10-year yield of 4.75%, and I think we're coming to grips with that as you get the second acceleration in the NASDAQ 100. Be careful in this market, folks. All right, we got volatility everywhere, and we have a market that has really gotten ahead of itself in terms of thinking that somehow the Fed is going back to where we were after the financial crisis. That's not how it works, folks. 0% interest rates don't make sense. It's not happening. We got a healthy economy, and there is no reason for the Fed to cut. You're talking about that they might cut out until October next year, this year. It seems like next year. It's so far away, right? All right. Let's jump around to some of the other currencies. There's your euro US dollar. You almost hit 102 today. We got some action in the yen today as well, man. These other central banks, they're going to have their work cut out, because think about it. What do they have? They have dollar strength. They have weakness in their own currency. And what's that do? That makes buying exports very expensive. That makes products more expensive. That means inflation is a problem for other. So what do they got to do? They got to deal with it. Maybe they got to deal with their rates. We'll be right back, folks.
Many trading newsletters attempt to focus on a narrow set of equities or commodities. While this works for some, it oftentimes misses many opportunities that possess huge gain potential. But how is an independent trader supposed to scan the entire market looking for these hidden opportunities? One simple answer: the Opening Call newsletter. Basil Chapman, developer of the Chapman Wave trading methodology, has been trading the markets for longer than most trading influencers have been alive. And over that time, he has honed his methodology in order to accurately call movements in a wide range of equities, from semiconductors to uranium to key indices and so much more. Basil is old school, taking the time to educate the trader while also giving his insights into key indices, selective stocks, and more. Opening Call subscribers also receive access to dozens of educational live streams that can be accessed at any time for your edification. All first-time subscribers receive a 30-day money-back guarantee. So ignore the pop trading influencers and start learning time-tested technical analysis.
For traders who crave risk, Direxion's daily leveraged and inverse ETFs provide opportunities to magnify short-term perspectives with up to 3 times a daily leverage, utilize bull and bear funds from both sides of the trade, and trade through rapidly changing markets. These are highly leveraged ETFs with daily resetting designed for short-term trading, not long-term investing. Whether you're a bull or a bear, you choose the Direxion. For up-to-date pricing and performance, go to Direxion.com. Investing in the funds involves significant risk and should only be utilized by investors who understand the impact of leverage and actively monitor their portfolio. They are not designed to track the underlying index or security for more than a day. Before investing, carefully consider a fund's investment objective, risk, charges, and expenses contained in the prospectus available at Direxion.com. Read carefully. Distributor Foreside Fund Services, LLC. Are you ready to take charge of your financial future? TFNN is your gateway to the world of trading and investing. Whether you're starting out or scaling up, TFNN empowers traders and investors of all skill levels with top-notch investing systems, strategies, and techniques. It's time to protect and grow your money with insight you can trust. Join us live Monday through Friday during market hours for exclusive content that moves with the markets. At TFNN, we bring the trading floor to you. Our seasoned hosts are here to answer your calls and questions live on the air. Check out the Tiger's Den for just $1 and follow us on YouTube and become part of our vibrant community. And remember, at TFNN, we're so confident in the value we provide that we offer a 30-day money-back guarantee on all new premium newsletter subscriptions and services. You have absolutely nothing to risk, so why wait? Tune in live to Tiger TV and transform your trading journey, because when you know better, you invest better. Join us and experience the difference today. TFNN, educating investors.
This program is brought to you by Vista Gold, traded on the NYSE American and TSX under the symbol VGZ.
Welcome back, folks. Markets picking up steam since we opened there. We were at 59.20. You just hit below a 5,800 handle in the S&Ps, and we're off by about 1 percentage point. NASDAQ 100 now off 1.2%. The Dow off 0.7, and the Russell off by 1.8%. And as I was talking about, here's a glimpse, okay? Now, this article is back from May of last year, but what it's talking about, okay, is small cap stocks are as cheap as they've been in decades, but with more than $500 billion. Now, what's interesting is May of 2024. Okay, you back things up. That's the Russell. You're talking about a price point of about 2,000, and you traded all the way up to 24.77. But guess what? Just like that, we're back to 22.14. And what it talked about here, okay, more than $500 billion, $620 billion, is going to need to be refinanced out of $832 billion in debt by 2029. Essentially, 75% of the $832 billion in debt that the Russell holds needs to be refinanced versus the S&P 500 that just has a 50% of their obligation due. You look at the Russell in black here. Can we blow this up? Here, let me zoom it in. Look at the Russell in black and the S&P in blue. We're already in 2025, but what's coming down the line the next 3 or 4 years? They're okay this year. What's coming down the line? If rates give you no reprieve next year, and we just said, what's the market price in right now? 1 cut in October. That's not going to do it. Okay, if we adjust to this is where we are right now, then man, smaller companies, they missed out. They should have had more duration when you had lower interest rates, as we are now adapting to a higher for longer policy. And look at the numbers, and these are the bigger share of debt coming due in the next 5 years, share of debt coming due, and look at it. On the S&P, you know, what do they have? They only have 10%, 10%, 10%. They got about 10% each year, and then they go down to 7.5, 6.9. The Russell, okay, has 17% of their debt coming due next year, 17% again the following year, and 18% the year after that. 56% of their debt is coming due and needs to be refinanced in the years 2006 to 2028. So when you see these types of moves in the market and in the Russell, That's a big reason why. They are very rate sensitive because of the shorter term debt that they need to refinance in the coming years versus the larger tech companies, especially even the S&P 500 you saw where it's only 50% of their debt. All right, what else do we got going on? Let's see. I got a couple articles pulled up here. Yeah, and this is one of the risks out here. You know, all we hear about are the American tariffs, but remember, a tariff war is what the real risk is. Okay, we talked about it with China. You see strong words. Now, Canada's got some issues with the economy, okay? More so than the U.S., that exceptionalism. But guess what? This is how it goes. Canada plots broad tariff retaliation if Trump starts a trade war. This is how it goes, man. Okay? If you get something like 25%, you better believe that it's coming both ways. The Canadian government's draft plan for trade retaliations go well beyond a narrow list of U.S.-made items. Let me back this out. I'm all zoomed in here. Yeah. So the headline here is that the government's draft plans, and these are all just headlines, okay? We saw what happened with Trump. You may see Canada deny, confirm this. It's a bolstering of a position in a negotiation, right? You want to have the strongest position there. There's going to be grandiose bluffing at points where the truth holds. We find out. But nonetheless, okay, that their plan could go beyond the narrow list of U.S. items which it had during the 2018 dispute. Now, that is because they're talking about if you get a broad 25% levy. That is a huge number. That's what the market's worried about. We saw the reaction when you had the Post come out with the story and say that it wasn't going to be broad. It was going to be narrowly focused on defense, chip stocks. Trump came out and said that's bogus. They're going to be huge and wonderful. But if it is as broad as something like that, you could see a broad basis back from Canada, and it wouldn't be surprising. This time, many of those same products would be hit again by Canadian countermeasures, along with items such as orange juice from Florida, where Trump and Republicans are based. But Trudeau's government is preparing to go further. I mean, it's not surprising in terms of where you could go, right? Yeah. Canada's imports from the U.S. So what could get hit? Cars and trucks. Going to be very difficult to be a car company selling Canada cars when Canada puts tariffs as well. Consumer goods, consumer companies, $55 billion worth of products. These are the reasons you want to keep the spikes up on your back. With equities at 6,000, with the economy doing well, okay, but with the potential. And here's the kicker, right? In a longer term basis, this isn't a decry of tariffs. It's just recognizing the reality of the impact and preparing for it as traders and investors, okay? Do not get caught up in the wonderful language of how great tariffs are and how China's going to pay for everything and Mexico and Trudeau are literally going to line our pockets with tariffs. Not how it works, okay? It's going to be American companies paying tariffs on those products you bring in, and then it's going to be these American companies, right, facing tariffs for the products that they're trying to sell to Canada, and likewise probably in Mexico, up and down the line. So there are risks there that are present in this market as the sell-off continues right now. Look at this. NASDAQ 100 off by 1.6%. The Russell off by 2%. S&P's off by 1.17%. And it's a tough jobs Friday. Let's check back in on yields. Okay, recoiling a bit, as we're just under probably 475, and the dollar settling at about 109.50, which is above. Let's put it back on a daily. I was going to say is above this high that we got recently. 109.533, literally sitting at the spike high we got January 2nd. Higher highs, higher lows in the dollar. And unless anything changes, it looks like we may be going above 110, man. There's nothing above this chart. Right, you back it up even further than that, folks. You're talking about going back to 121 in the year 2000, 1999. Let's get prints out here. I have to. Why not? So big numbers, to put it lightly, right? You're in territory here that the only thing looming here is 115 to 120, and you're trading at 110. Dwarfs anything we have prior to this market. It's not stopping just yet, man. Dow off 400 plus right now. approaching a full percentage point. Yeah, the S&P's off by 1.2. Let's check in on some of the Magnificent Seven. Whew, even a company like Apple off 2%. Watch out in this market, man. Amazon off 2%. Microsoft off 1.3% right now. Alphabet, Google off by a percentage point. Tesla off by 1.3. Nvidia shares taking it on the chin, off by 3.8% right now. As equities trade lower, yields higher for longer, dollar strength, and the Fed not going to be cutting anytime soon. When is the hike conversation going to come into play? Can you imagine? So much for that 50 basis point cut just in September. Stay tuned, folks. One more segment. Be right back.
Many trading newsletters attempt to focus on a narrow set of equities or commodities. While this works for some, it oftentimes misses many opportunities that possess huge gain potential. But how is an independent trader supposed to scan the entire market looking for these hidden opportunities? One simple answer: the opening call newsletter. Basil Chapman, developer of the Chapman Wave trading methodology, has been trading the markets for longer than most trading influencers have been alive. And over that time, he has honed his methodology in order to accurately call movements in a wide range of equities, from semiconductors to uranium to key indices and so much more. Basil is old school, taking the time to educate the trader while also giving his insights into key indices, selective stocks, and more. Opening call subscribers also receive access to dozens of educational live streams that can be accessed at any time for your edification. All first-time subscribers receive a 30-day money-back guarantee. So ignore the pop trading influencers and start learning time-tested technical analysis.
Steve Rhodes started his trading career as a student almost 20 years ago, and the student has now become the master. Steve won the prestigious Timer of the Year award in 2018 and barely missed that mark again in 2019, finishing at number 2 for the year. An amazing accomplishment. Steve Rhodes is committed to sharing his techniques and knowledge with anyone who wants to learn, and he shares his vast amount of trading knowledge every day in his Mastering Probability newsletter. Steve's award-winning newsletter, Mastering Probability, is delivered every trading day with updates throughout the afternoon. Sign up for Steve's market newsletter, Mastering Probability, and you'll receive access to 7 of Steve's educational webinars absolutely free. At TFNN, all our newsletters come with a 30-day money-back guarantee, so you have absolutely nothing to worry about. Visit TFNN.com and try Mastering Probability 30 days risk-free today. TFNN, educating investors.
The reality is that navigating financial markets can be risky. Markets can be chaotic and difficult to understand. Having the latest market advice can help you turn this chaos into a key for creating winning trades. At TFNN, we understand that it can be hard to find reliable market news. That's why each of our market experts offers their very own market newsletter, a must-have tool for every trader out there striving to find an edge in today's markets. TFNN newsletters cover every aspect of the markets so you can analyze the market before you trade. Try any of our great newsletters risk-free with our 30-day money-back guarantee. Just visit the Newsletters tab on the front page of TFNN.com. TFNN, educating investors.
Don't forget, you can listen to TFNN live on your mobile device 24 hours per day. Go to TFNN.com, then hit Watch Tiger TV. That's TFNN.com, then hit Watch Tiger TV.
Welcome back, folks. S&P's sitting right at almost session lows right now, off 1.2%. NASDAQ 100 off by 1.5%. The Russell off by 1.8%. And the Dow off by 0.9%. We checked back in on the dollar, 109.60. Talk about dollar strength, man. You jump over that gold contract, holding up so well. Gold, a safe haven right now. Gold up $32, up by 1.2%. Even with a strong dollar, you're trading gold in other currencies. Boy, you're making money in a big way. And yeah, we got some action. And boy, keep the people in California in your thoughts and prayers, folks. This fire, I mean, I'm sure we've all seen some of the pictures. Pretty remarkable. Whether it's, we deal with hurricanes, of course, in Florida, St. Petersburg, dealing with back-to-back, the whole coast over there. Something about seeing the fires that roll in, man, and just how quickly things go. And so the Journal had a piece out there. Starts Tuesday at 1:30 Eastern time, right? I mean, just like that. Fires, and it makes sense how quickly. By 11:45, an hour later, you had the first evacuation orders out there. By 12:30, just 2 hours, you had an evacuation order of 40,000 people. You see where the Fat Palisades fire started. You see the evacuation area, Pacific Palisades, Santa Monica, right there, right next to it. The fire spans 200 acres. And just like that, it spreads within the hills of the Palisades. You have very populated areas, a lot of movie stars. Not like they're any more special, but they're making headlines, man, when you see the amount of houses. Yeah, look at these visuals, right? So keep them in your thoughts, keep them in your prayers, man, as that thing just rages. The story, at least, is that you're going to get some lower winds coming in, and that may help them. The winds, look at the winds. 40-mile-an-hour gusts of winds, not what you wanted in that situation. Devastation, loss of life. Keep them in your thoughts, keep them in your prayers, man. Insurance going to come into that as well, as it does in the U.S., in Florida with our storms. All right, folks, stay tuned. Our man Basil, he's out today. He's recovering, but he's doing well. Talked to him this morning. He'll be back on Monday. But so we got a little bit of a replay right now. But then we got our man Steve Rhodes coming up at 11. Fast Market at 12. Larry, he's doing live trading right now. It's a wild day for that, for sure. I'm sure they're having fun over there. But he'll be back as well. Jacob Shoup this afternoon. Have a great Friday, everybody.